Hello, everybody. Welcome to the webinar on Deeper Dive on Mortgage Financing Tips. I'm joined today by Rob Grossinger, who heads up Community Stabilization for the Enterprise Community Partners, and also by our friends in HUD Community Planning and Development, who oversee the Neighborhood Stabilization Program. I think John Laswick, David Nagara, and Hunter Kurtz are all with us. So thank you for joining us and for all your support. Jenny, why don't we move into the presentation here? Let me see the names, and we'll just move on to kind of a reminder on how to ask the questions. This is one of three sessions that we're conducting, HUD-sponsored sessions on financing. The first one was last week on some of the basics around lessons learned at some mortgage financing roundtables we held last summer. We'll talk a little bit more about that. Today we're going to do a deeper dive on some of the key mortgage financing tips. And then on February 2nd, we'll be talking about interim financing, financing that's used to help facilitate or leverage private capital for acquisition renovation, the short-term financing you need to redevelop and reconvey property. So what are we going to cover today? We're going to cover four primary topics. First, we're going to discuss how the design of soft second programs can really affect the mortgage credit that we're seeking for our borrowers. We found through the roundtables this was a very important topic and one of great frustration. Secondly, we're going to talk about some of the key elements of the conventional conforming market and also the FHA mortgage products and compare them, be able to help you determine for your borrowers when one is better than the other. There's no one answer there. It really depends on a number of factors. Third, we'll determine which products work best given different borrower characteristics, which scenarios would largely influence the kind of product that you're seeking for your home buyers. And then lastly, we'll talk about some strategies to increase participation by both the national and regional mortgage lenders and even community lenders within your community related to NSP. Now I'm going to go through the next few slides rather quickly because I have to suspect that a good number of you attended last week's session. But this is just a refresher and intended to really bring the others up to speed here on what did happen last summer. HUD had requested that Enterprise Community Partners and the National Community Stabilization Trust lead a series of discussions around the country on what's working and not working with mortgage lending in NSP markets. They heard loud and clearly from you that there were a lot of difficulties in helping obtain mortgage financing for your borrowers, particularly when you spend a lot of time and effort finding the properties and accessing them, purchasing them from financial institutions, then renovating them, only to find out mortgage capital was so tight. So we conducted these 6 sessions. You can see the locations: Chicago, Orlando, Los Angeles, Sacramento, Newark, and Atlanta. In each of those sessions, we had typically 5 or 6, maybe 7 lender representatives. Always had at least Fannie or Freddie at the table, some large lenders, national lenders like Bank of America, Wells, Chase, Citi, and we'd have some regional or local players as well. And then the remainder of the 20 or 25 attendees were NSP grantees and their subrecipients. It really created a small, intimate conversation about what's working and not working. And I think we came up with some important takeaways. We mentioned 5 of them here briefly. First, and this will be no surprise to you, securing mortgage financing from prospective buyers was a daunting challenge. In fact, in both those roundtables as well as an assessment we did that preceded the roundtables, 75% of the NSP respondents said it was a big, big problem. Secondly, we heard that tighter credit standards in the wake of the housing crisis has become, in their eyes, the biggest obstacle to success. 57% said low credit scores were a problem. Another 52% said poor credit histories, bankruptcies, recent foreclosures were a problem. Another 32% talked about the fact that property values were still declining, and that was a problem. So certainly credit was top of the list of problems. Thirdly, as we mentioned, soft seconds, subordinate financing structures created a lot of at least delay, if not preventing a lot of deals from going forward. A lot of the financial institutions have become more cautious in looking at the subordinate financing structures. Rob will speak to that in a minute. Fourth, go to the next page, Jenny. We found that this was a real takeaway, a surprise to me at least, that perhaps in more than any other factor other than credit, we heard from grantees that low appraisals or inaccurate appraisals or using inappropriate comps were a major problem and were precluding borrowers from being able to qualify for a mortgage. And then lastly, sort of a pervasive misinformation among housing industry partners on what is NSP, how does it really work. We needed to convert lenders and others into understanding these are markets of opportunity, not distressed markets where risk is higher. So what about today's landscape? There are fewer mortgage originators. We literally have three of our top lenders, financial institutions in this country, Bank of America, Wells Fargo, and Chase, that originate more than half of all mortgages, although that is changing. We've seen a surge in the last 9 months where a lot of other lenders, regional lenders, are really stepping up and providing some responsive mortgage products across the board. But today's landscape is also marked by a resurgence of FHA. There was a time back in 2005, 2006 where FHA was about 4% of the marketplace, and now they're about 30% of the marketplace, and more than half of all first-time homebuyer mortgages are being originated with FHA insurance. This is also a market, if you go back just a minute, there you go. It's also a time when there's a sort of reawakening at the GSEs to a conforming marketplace. Without the existence of subprime mortgages, we are seeing a sort of back to basics from the GSEs, Fannie and Freddie, trying to provide more liquidity, stability, and affordability in the marketplace, although perhaps with a little bit more of one hand tied behind the back given the current situation with the GSEs. Thirdly, underwriting fundamentals are we're back to the fundamentals and we're back to really tight underwriting standards. Frankly, we're seeing that pendulum swing way in the opposite direction of where we were back in prior to the housing implosion. And lastly and importantly, and we'll come back to this point, the emergence of some very interesting new portfolio products being originated by lenders specifically for neighborhood stabilization purposes. Okay? And this just sort of reminds us all of what those 3 C's are that we learned many years ago. It is back to the basics. So we need to be thinking about credit, particularly the impact that tighter credit scores will have on qualifying, and that's particularly the case in the conventional mortgage market. We'll be relying heavily on the automated underwriting tools that Fannie and Freddie use and that FHA use, Loan Prospector for Freddie, Desktop Underwriter for Fannie Mae, and unfortunately less reliance on compensating factors. And by that what I mean is because most loans pass through an automated underwriting system to begin with, it's going to really require that loans be pulled out of that system when they don't immediately qualify and look at them from a manual underwriting basis and look at ways that we can compensate for the factors that are otherwise perceived as high risk. We'll explain that in more detail in a little bit here. The other 2 factors you're familiar with, capacity and collateral. With capacity, debt-to-income ratios have tightened. We were getting up in excess of 50, 55, 60% total debt-to-income. We're going to see those down around the mid-40s now. And that has significant implications when it comes to soft seconds, particularly how you apply those soft seconds, because, frankly, very easily you could be solving for debt-to-income and create an issue on loan-to-value. And then lastly on this slide, I think it's important to note that more than ever, having some borrower skin in the game, some borrower coming from them, is always important to helping qualify borrowers. And I guess this is me too, Rob. So lastly, with NSP funding flexibility, there are a number of programs that can help here. But it's key here as we go forward through the rest of this presentation, you think about what these obstacles are that we're trying to overcome and look for solutions, whether it's the monthly carrying cost of that principal, interest, tax, insurance, the lack of cash for closing and down payment, and certainly, as we talked about, the biggest barrier, impaired credit, or the fact that there's been some recent foreclosure or bankruptcy that the borrower is living with. So this might be a good time to just take a pit stop before I turn it over to Rob and see if there are any questions.
We do have a few questions. The first one is, you mentioned NSP lender programs, like who?
Well, I hate to delay the answer, but we're going to talk about some of the portfolio products and some of the other products the primary lenders have here a little later in our presentation. Suffice to say that we're seeing both a lot of the regional and community lenders started with some portfolio products that seem responsive, and now we're beginning to see some of the big national players also explore the possibility of a NSP-type product as well.
Okay. Also, I just want to do a quick reminder. To ask a verbal question, please select the hand icon. You will be placed in a queue, and I will identify you once your line has been unmuted. You can then ask your question. After the question has been asked, please deselect your hand icon. I'm not seeing any hands up, but I do have, I'm not sure if it's a question or a statement, but it's, I'm working with Wells Fargo on current NSP mortgage. It is taking them forever to approve the NSP program for this particular loan. It also took them forever to approve a first-time homebuyers program that I run for this particular buyer as well.
Actually, I think that's an ideal sort of segue to Rob, who's going to talk about soft seconds. And I guess the short answer is that this person is not alone. It's something that we're all experiencing in terms of slow processing and lenders trying to get their arms around what this new NSP is all about. Rob?
Thanks, Craig.
I have one hand raised.
Oh.
Sorry.
Go ahead, Jenny.
You've been unmuted.
Yeah, hi. My name is Dave Mignolo with the City of Perth Amboy. I'm the one that typed in the Wells Fargo question. Yeah, I mean, we have an NSP buyer, a house, she's already been approved and everything. Like I said, it just seems to be taking forever. One, we have a first-time homebuyers program where I give $8,000 towards the down payment. It took them forever to approve that, and then now that got all approved. They're ready to go with the mortgage, and then next thing you know, Wells Fargo needed to approve the NSP program, and that still hasn't happened. We've had this person renting from somebody else because they can't move into the house because of the delay. It just seems, I don't understand what's taking so long for them to, I guess they're being very cautious about the way they're lending money out, like you started to say.
Yeah, I think one of the things that we discovered, this is Craig, that we heard loud and clear from these roundtables is that many of the community lending staff, the loan processors, the intake representatives, even underwriters, are not familiar with government programs and certainly not familiar with NSP. But there are people, what many of the lenders said is, when that happens, we need to know about it in our community development teams. And what we'll do is get in touch with those folks, explain what's going on, maybe allay some of their concerns. Frankly, a lot of these originators now are more cautious than ever, and then help them just kind of get over some of their hesitancy. On this particular situation, if you would like to contact Rob or myself after this session, we'll deal with the specifics and give you the names of a couple of people you could call at Wells Fargo.
Great, thank you very much. I appreciate that. I don't know if it was, like I said, not an understanding of one, the NSP program, and two, the program we had was like it was we were going to hold third place mortgage, but yet it was just still like we had to jump through hoops just for even to get them to approve our mortgage. But that would be fine.
Great.
All right, so I think it's time for, this is Rob Grossinger, and time for me to take over here. I'm going to, as I was listening to that last exchange and thinking a little bit about what we've heard, and this is where Craig always gets nervous when he moderates things with me. I'm not going to go off script, Craig, don't worry about it, but I do want to hit a couple highlights about things that make this more difficult than it should be. So let's start with this whole concept of NSP program mortgages, or NSP soft seconds, or NSP down payment assistance. I could spend from today until the end of the week talking about how the structure of the major national financial institutions makes it very difficult for them to understand anything in specificity, and that things have to be done in sort of multiple executions over and over and over again, something that they can build into a understandable process for them, so that they're able to then move forward. So I'm going to put this in the language of something that may make sense to the lenders that you're working with. They may not understand the NSP program, but they do understand what a down payment assistance grant or loan is. And so the more you tie this to things that they understand, language they understand, and I think that came out very loud and clear when we did these roundtables around the country, is that even the use of particular words has different meanings to you as an NSP grantee, to the home buyer, and to the lender. There are just different languages that go on. Different words have different, sort of instigate different thought processes and cause multiple problems. So let's take a look at the soft second structures. And when we talk about this, what we're really just saying is you may be choosing in your community to use your NSP money to somehow make that mortgage more affordable, whether it's increasing the amount of down payment that can go in to bring down the total principal amount that's borrowed. The different ways that Craig was listing before, you can use that. The question is, are you doing it for what social purpose or what public policy purpose? If you're doing it to simply help more borrowers become eligible to buy the house, then there's one approach that you may want to think about. If you're doing it to maintain affordability for the long run, to sort of create an affordable housing stock for an extended period of time, that has different implications. And the third is, if you're doing it and you're trying to protect against any possible gain the homeowner can get from your largesse, so to speak, then you're going to be putting other restrictions on which have even more unintended consequences. So you got to think through your public policy, where you're coming from to start. So most providers of NSP or any kind of down payment assistance or principal reduction assistance or any of the kind of largesse we're talking about put in some form of a recapture provision, because what they don't want the homeowner to do is flip the house, take advantage of that money, and walk away with it by selling the house, even just for the same amount they purchased it for, and being able to recapture that sort of extra grant money. So there'll be some form of, if you sell either within this particular time, or if you ever sell, there's a recapture of that assistance that's provided. I'd ask you to think about how, what sort of time period you want, what sort of time period the first mortgage is. Try to line things up so that they work together hand in hand with respect to what you're providing and the other sources of funding that are coming into the mortgage. And try and remember what your real public policy purpose is and stick to that. Don't get sidetracked by things that all of a sudden you think of, oh, it would be nice if we could do this or it would be nice if we could do that, because the more you lay on top of the requirements for this, the less likely it is any lender is going to want to come to the table with you and be a first lien lender while you're a second lien lender. So the question is, under resale, and you look at that bullet point, if you want things to extend beyond the term of your assistance, or worse yet, and I say this not from a public policy standpoint, but from an administrative standpoint, beyond any sort of sale or transfer, you're simply making this more difficult to execute. The one thing I will say that is if you try and make that affordability requirement stay alive post-foreclosure, you'll never have a lender participate with you as a first lien lender. They need, when they take a property through foreclosure, they need to be able to sell it to whoever is willing to buy it, and they need to be able to sell it as quickly as possible. So the more bells and whistles you put in, the slower the process is going to go. That doesn't explain the prior statement about, it's taking forever, but what I would ask is that you think about this. As you put your program together, you should be putting it together. Now, most of you, I'm hoping most of you on the call already have your programs put together. But if you have the capacity to change them or you're creating a new one now, sit down with the lenders you want to be part of your program and structure it with them. Don't try and structure it and then say to them, this is our program, you have to adapt. Big banks don't adapt. That's just the bottom line. And so if you think they're going to adapt for you, whether you're representing the state of California, the city of Chicago, or the town of Biloxi, Mississippi, they're not going to adapt. They can't. They are structured in a particular way to do what they do. They're going to want you to adapt to them, and as usual, the 600-pound gorilla in the room gets to call the shots. So structure this in a way that the lenders you want, and if you want to then rely on regional or even local banks, fine, but find those people that understand what you're structuring so that you're not going buyer by buyer to them saying, all right, here's this buyer, Mrs. Jones, I want you to approve this first-time home buyer assistance I'm giving. But if you can say this is exactly the same way that we've laid out in the program you've already approved, we already sat down with you and you approved it, there should be no delays because they're going to see the exact same paperwork and the same content of that paperwork that they saw in putting the program together. There are, everything sort of works together, sometimes in negative ways, sometimes in positive ways. When you add this money to be helpful to the home buyer, but you put a lien on the mortgage, you're adding to their CLTV, their combined loan to value, and there's a limit on that as far as how high they'll go. Even if your document states this is a non-amortizing loan, that it's forgiven in 10 years, it doesn't make a bit of difference. A lien represents the loan, which represents the total of the loan, which can butt up against or exceed the combined loan to value that your lenders are willing to go for with a first lien loan. So most importantly, and we've stressed this every time we talk, whether it's in a regional roundtable, on one of these webinars, or just walking down the street, you have to conform to the secondary market requirements. If you want any lender who is going to be selling their loans into the secondary market, Freddie Mac or Fannie Mae, your requirements have to conform with their requirements, and they are very easy to find. I think, can we go to the next slide? Let's go one more. Well, I thought we were going to put those into this deck, but they're very easy to find by going to either Freddie Mac or Fannie Mae's website, and we will try and get something out, or Craig and I can get something out to tell you exactly where those soft second requirements are. And when I turn this back over to Craig, he may be even able to tell you off the top of his head. So it's very important to follow those. So we're now into page, or slide 14. I just want to walk through these questions because they're not really questions. They're, if you do this, okay. If you do that, no, not okay. They're posed in questions, but they really should have little skulls and crossbones after the ones where if you do that, there's no hope of ever working with a lender. Again, CLTV, you don't want to go above 5% because most mortgage products aren't going to allow that. If the money is coming not from you, I think this is probably moot for all of you on the call, but just make sure that whoever's providing this assistance represents something that the lender can be comfortable with, whether it's a governmental entity or a nonprofit or an employer. It's something they're much more comfortable with dealing with. You will never get your lien to be above, in the pecking order, the first lien of the first mortgage lender. I don't think anyone even tries. So I'm laying that out there, but just remember that's just not going to happen. The rest of these, instead of reading them one after another, which can be kind of boring, understand that what these questions are telling you is, if you've done this, you've probably violated the underwriting rules of the lender you're with, and almost any lender. You really have to structure your assistance in a way that there's no additional gain to you, there's no additional requirements beyond what any lender would allow, and it doesn't add to the combined loan-to-value. So, for example, if you're saying you're going to do a shared appreciation where you're going to provide some assistance, and if they sell the property at a appreciated price, you're going to share some of that with the seller. You have to make sure that you're not trying to claim more than what your fair share is of the total value of the home. Negative amortization for all of you, it just means taking anything that you're deferring and rolling it into adding to the principal. That's a no-no across the board, even for first lien lenders now in the most situations. So you really just want to be careful with all of these, that you have vetted them with the lenders you want to participate. We're finding that the most successful assistance programs, and again, I don't want to limit it to just NSP, because there are state-run programs and municipal-funded programs, and even philanthropy will fund some of these sort of programs. The most successful ones are the ones that have sat down with the lenders they've targeted in their community and said, I'd like you to participate when we're making this assistance available. Here are the documents we plan to use. Please show them to your lawyers and let us know what you think. Negotiate that ahead of time. Again, you don't have a tremendous amount of negotiating power, because the lenders, the bigger the lender, the more stuck they are in their particular process. But there are some places in which you can make a viable argument about why you want to do something that they may be willing to say, okay, we haven't done that before, we'll do it now. Please sit down, go through that. If you come to them with a loan and say, oh, and by the way, here's the assistance we're giving and here's the documents for it, and they haven't seen it before, it's not only going to take a lot of time. If there's any deviation from the way they do things, it'll never get approved. I'm sounding draconian only because we've been hearing this for years and years, and an ounce of prevention goes a long way. Getting it done on the front end and getting the approvals done on the front end with your targeted lenders makes you happy with your lenders and makes your lenders happy with you. Let's keep going, Jenny. One more. One more after that. Okay. As I was saying before, any deed restrictions that you are trying to keep in place post-foreclosure, no lender is going to accept that as a set of documents. We talked about shared equity. Combo programs are where you try and do, multiple things. You try to accomplish something at resale and a recapture, but you're also trying to accomplish something else. Don't make it complicated. Keep it simple. I'm going to go to the next slide. We keep hearing that in every political venue. It's the economy stupid, it's this stupid, it's that. So in this case, simple, simple, simple. The more bells and whistles, the less likely you're going to be successful. And all it's going to do is frustrate you, and then that's not fun. Nobody wants to be in that position. So as I said, the very last bullet point, if you've already done this with your home programs or your CDBG, that they do understand that, and so the similarity between the programs are not necessarily that similar, but your program should be similar, because they are not good at, I shouldn't say they can't, but they're not good at reinventing the wheel. Financial institutions, for whatever we want to say, have gotten so big, right or wrong, that their processes are very difficult to ask them to make exceptions, to ask them to deal with your community differently than they do with the rest of the communities. You can get that with some of your local institutions, but their lending, their capital sources are usually less, and you may be able to get it with some of your regional. So I'm going to stop there and see if we have questions.
We do have a couple of questions. As a quick reminder, to ask a verbal question, please select the hand icon. You will be placed in a queue, and I will identify you once your line has been unmuted. Then you may ask your question. After your question has been asked, please deselect your hand icon. We do have one question here that says, I was a participant at the Newark session where a draft overview for NSP-2 mortgages was distributed. Has this been made final? If so, how can we get a copy of it?
I will defer to Craig since I didn't attend the Newark session.
Well, I did, and I even recall it, Rob, which is good these days. I think we were referring to the mortgage guide. There was a draft of a mortgage, how do NSP grantees access mortgage credit for their borrowers, a guide of some 45 or so pages that was drafted in advance of the roundtables. And we then, after the roundtables this past fall, went back and edited the document, updated some of the material, and incorporated a lot of the interesting takeaways that we heard at the roundtables. That document now, I think, is within weeks of being available to the public, and I don't know if David or John want to speak to it, but I think that it'll be broadly disseminated by HUD at that time.
Next question. For Wells Fargo, contact their SPA, Special Programs Administration Department, and have your program approved beforehand, and it will expedite individual processing issues. The same goes for most banks.
Okay.
Yeah, and I appreciate that statement from Andrea, because otherwise I just would have given out Muffy Gabler's email and made her miserable.
One thing that... oh, go ahead, Brandy.
I'm sorry. Do you have thoughts on whether or not the SAFE Act has implications on nonprofit NSP grantees developers who are giving an NSP soft second?
Rob, did you want to comment?
No, I don't have a feel for that one.
I don't think it does. I think Rob said this in his remarks, but I really think that a lot of times we're making things more difficult than they need to be. The sort of checklist that Rob went through is actually from the Fannie Mae website. And I found that in talking to financial institutions, the lenders on the ground, if you make it clear to them that you are adhering, your soft second adheres, complies with either Fannie Mae's community seconds, Fannie Mae calls their guidelines community seconds, Freddie Mac calls theirs affordable seconds. If you tell the lender that these guidelines, that your soft second meets the test of Fannie's community seconds and Freddie's affordable seconds, and I would believe in 99% of the cases it does, that gives them comfort. That may discourage them from doing the sort of sausage-making review through many channels of a large lending institution, because they know that guideline has already been used by them endlessly for years as a safe harbor. So I think that's key to this thing, that the GSEs are trying to make the soft second structure easier. We just have to have the primary lender connect the dots from your program to those guidelines.
We also have a live question from Brenda. You're unmuted. Please go ahead and ask your question.
Good morning. This is Brenda with Affordable Housing Clearinghouse in California. I just had a suggestion for working with the lenders. We have found that we succeed more when we have a lender participation or introduction to the program of those who want to participate. And if you go over the program with them, with those who attend, you actually have a better success rate of processing your NSP funds, because if you keep the same folks on your roster that you work with, it makes the process a lot smoother.
We couldn't agree more, Brenda.
We have a couple more questions. The first one is a statement, I believe. We are having our third meeting with our 7 primary lenders and their respective local originators. Soft second design points will be extremely helpful to us. Okay.
Well, I think these webinar decks are available after the sessions, and I think you'll find in there a lot of the guidelines you want. Let me also, I don't want to belabor this point because we have more to cover here in terms of the products themselves, but let me, Rob mentioned an email access that I might have, and I did dig it out while he was talking. to obtain Freddie Mac's Affordable Second Guidelines, you would go to www.freddiemac.com /sell, S-E-L-L, /EXPMKTS, the abbreviation for expanding markets, EXPM, as in Michael, KTS, almost done, AFFSEC, for Affordable Seconds, AFFSEC. If you do that, you'll get all of their guidelines there in a simple framework. For Fannie Mae, it's about the same length, but let me try it quickly. www.eFannieMae, E as in electronic, www.efanniemae.com /SF as in single family, SF /mortgage products /PDF /CS checklist.pdf. Okay, that last part was C as in community, S as in seconds, checklist.pdf. All right?
Craig, this is Hunter real quick. I think we probably can get that information posted on the slides so that we can update the slides on the website and have that information on there.
Awesome. Great. Okay.
Also, we have a couple more questions. With regards to Wells Fargo, I did go and have been dealing with the SPA group, and that is where the holdup is. I believe that's a follow-up from the previous question.
Yeah, we're going to follow up. Rob and I will follow up with the Wells Fargo team. They have been. We've met with them any number of times around neighborhood stabilization. They have created some new products that are very focused on neighborhood stabilization, and I think we just need to make them aware that there's some consternation out there among the grantees still.
Okay. Last question. SAFE Act isn't causing a problem, but the lack of final rules from CFPB on QRM and QM seems to be. Any thoughts?
Well, I mean, yes, the QRM stuff is huge. It's sort of like a black cloud that's hanging over all this, but I don't think you should expect any sort of clarity in the very near future. I know they have gone back to the drawing board, and they are now rethinking the notion that any mortgage request that includes less than 20% down is somehow inherently a high-risk loan. I think we've, and this is my term, not HUD's, I think we've beaten them up enough that they're sensitive to that fact and looking for a more surgical way to get at high risk rather than just the LTV or the amount of borrower equity. It is something we're going to have to be diligent in watching, but I feel comfortable that there are structures in place that will avoid this being a real obstacle for us going ahead. Shall we move into products? What we want to do in this next segment is talk about some of the key mortgage products, maybe some that you're already familiar with, give you an update on them, and I want to acknowledge one other participant in this presentation here that I was negligent at the beginning in acknowledging, and that's Matt Callahan. Matt's based in California in the LA market, specializes in neighborhood stabilization lending, and also specializes in first-time homeownership lending, does a lot of FHA and conventional. He was also one of our partners on these mortgage roundtables as we went around and facilitated these discussions, so he has the benefit of having heard from a lot of grantees. And I asked him if he would join us in this discussion, and I'm going to ask him to add some real-life perspective to some of the things that we're talking about here. So we're going to talk about the conventional conforming market. That really is just the term often given to what Fannie Mae and Freddie Mac represent, the GSEs, government support enterprises. We'll talk about FHA, and then, as someone requested earlier, we'll talk about some of the kinds of portfolio products we're beginning to see in the marketplace. So first, let's Jenny, if you can move to the next slide here. Let's talk a little bit about the conventional marketplace. It certainly has changed from 5 years ago. It is a much more cautious and methodical process than it used to be. But certainly the key automated underwriting systems are in place and are being used. And, these are good tools. I must tell you that I think that both LP, Loan Prospector, and DU, Desktop Underwriter, do a wonderful job of quickly assessing layers of risk and determining what is an approvable loan or not. That's the good news. The bad news is, given the unique circumstances of some of our borrowers and some of the types of activities we're undertaking in NSP, sometimes that sort of one-size-fits-all series of algorithms to determine acceptability of a mortgage just doesn't work as well. It's the extenuating circumstance that gets lost in the fray. And so we're working with the GSEs to make sure that they not only use these automated tools, but that we have manual overrides to look again at those borrowers when the AU system, the automated underwriting system, doesn't work the way it's intended. But they're good systems, and they've been refined over and over for the last 20 years. PMI. We're not going to spend a lot of time talking about private mortgage insurance here today, but it's important to remember that when you are doing conforming loans and that loan to value exceeds 80%, the GSEs are required by law to have some form of credit enhancement, some form of mortgage insurance. And and frankly, I think the private mortgage insurers have been more in the bunker than anybody over the last few years. The good news is we're seeing the PMIs become financially stronger, come back into the mix. There was a time there a year ago where it would be hard-pressed to find an MI that was willing to insure anything with the LTV above 90%, and that's changing. We're back up to the 95%, in some cases higher than that level now. And I think it's important because they play an important role in this whole process. One little sidebar here that we mentioned last week, but I want to mention again, is that private mortgage insurance, unlike FHA insurance, private mortgage insurance has been deductible on a homeowner's income tax. That started in 2006, and that was the case all the way through to the end of 2011. But that legislation was not renewed. It may still be, but right now borrower cannot deduct the MI coverage. And then, of course, the two products we're going to spend a little time talking about here are Fannie Mae's My Community Mortgage and Freddie Mac's Home Possible. These are the flagship programs for those two GCs when it comes to affordable lending. They precede NSP, but they can very effectively sometimes meet the needs of your borrowers. So let's talk about those in a little bit more detail. Fannie's My Community Mortgage. And I'm going to ask Matt to comment on both of these products in a minute, but the LTV can be as high as 95, and I think in some instances actually can even go up to 97%, including the financing of that MI we just talked about. There's not necessarily a minimum borrower contribution, but believe me, it is an important factor, and I would encourage you to have a borrower contribution to increase the likelihood of approval. The combined loan to value, the CLTV, then by combined we're referring to the first mortgage that would be the My Community Mortgage, as well as any other indebtedness, maybe your soft seconds and other forms of indebtedness, cannot exceed 103%. Sometimes that can go, I think, Matt, as high as 105, but when you get above that, it's going to be tough. So you'd look for a LTV below 95 and a combined loan to value, hopefully no higher than 103%. It's tough to pinpoint a credit score and say, this is your threshold. You'll see we put in parentheses there, manual. With automated underwriting systems, with the desktop underwriter, you could find a My Community that qualifies at 630, 640, maybe 620 because of the other contributing factors. Maybe there's a lower loan to value. Maybe that you've provided a very deep soft second that makes it all possible. But we do know this. when it does not get approved officially, it's not an accept in Desktop Underwriter, the instructions are to use a minimum credit score of 660 when you are manually underwriting the loan. So it gives a little picture into what may lie ahead for your borrower. No reserves are required on a one-unit property. What do we mean by reserves? Lenders will look at how much cash is available to that borrower in an account, in an identifiable account, to document that if there's a rainy day problem, the heating system goes out, the roof starts leaking, that they have something to fall back upon. With my community, on a single-family home, there's no requirement for reserves. There is a 2-month reserve, which means 2 months mortgage payments reserve for a 2 to 4 unit property. And then lastly, non-borrower down payment from a properly documented gift, grant, or community second is key to this, right? So if in order to qualify for being a soft subsidy, you want to make sure it is a grant, a gift, or one of those community seconds that Rob walked us through before. Let's compare that to Freddie here, and then I'd love to hear from Matt on what his experience has been on the ground. Freddie's program, Home Possible, is very similar. LTV of up to 95%, including finance MI, but here's where it differs. Currently, the combined, the CLTV, is only up to 95%, not 103, 95. So that means you're really going to have trouble applying your soft seconds to a Home Possible mortgage today unless the LTV is much lower than 95 and your soft second is bringing it up to 95%. Big difference. Again, there's no minimum borrower contribution, but you see the asterisk there. We really think it's advisable. And similar to my community, I don't have to say it all, no reserves for one unit, similar credit score threshold. Counseling is required for first-time home buyers. That would be true for Fannie Mae's product as well. So that's a quick snapshot on the two GSE products that are most widely used for this purpose. Matt, in some of the roundtables, I heard that there was difficulty in making a My Community or Home Possible mortgage in this current environment. Has that been your experience?
No, it hasn't, Craig. And I would say the majority of the clients that we're assisting with NSP or NSP-type assistance programs, especially where the LTV is going to be at or below 80%, these products are a perfect fit. They're designed to accommodate community lending initiatives. And the other point I think is important that may be what people think is not true is that the overall pricing can be better. The overall cost to the consumer can be better than a so-called regular Fannie Mae or Freddie Mac loan, because if you have a lot of overlays and, say, lower credit scores or lower reserves or higher LTVs or whatnot, you're going to get a lot of hits on your final pricing of that loan. Home Possible and My Community Mortgage eliminate almost all of those hits, and so your final pricing and cost can be much more favorable. Good.
Thank you. Let's talk about FHA here for a minute, and then we'll compare FHA to some of these conventional products. I think you all know about FHA financing, a loan guaranteed by and conforms to the FHA requirements. Ginnie Mae is actually the secondary market buyer of these loans, but FHA is insurance. It is the equivalent of the private mortgage insurance we talked about before. But FHA creates the guidelines. There's an upfront mortgage insurance premium and a monthly mortgage insurance premium paid on those loans. They tend to be a little higher than the conventional mortgage insurance for the same level of coverage, and we'll talk about that in a minute. And we'll talk a little bit about the two primary FHA products that you would find your borrowers using. 203B, it's sort of the baseline, most popular purchase mortgage structure, and then 203K, the purchase rehab loan. So with the 203B, minimum FICO, again, it's hard to say minimum. You'll see some literature that talks about being able to lend with a credit score into the 500s, but our experience is that the lenders are pretty uncomfortable underwriting anything with a minimum FICO below 620. The debt to income generally can go beyond the 45% with some compensating factors. The factors might be the nature of the debt they have, or the nature of why their credit score is lower than it might otherwise be. LTV is 96.5%, means a 3.5% down payment from someone. And that down payment can be from the borrower, but it also can be from your grant or soft seconds, as long as it comes from a government or nonprofit entity working with the government. There are some frustrations out there around the slowness of the FHA homeownership centers approving a nonprofit for that ability to provide the down payment assistance. There's no post-closing reserve. We talked about reserves before. No reserves required on a single family, and of course a key difference here between MIP stands for mortgage insurance premium. With a conventional mortgage, that mortgage insurance premium will go away, can go away upon request after the LTV is below 80% of the median. So if you got a mortgage and with a soft second, it's at an 85% loan to value, and let's say after 4 years you've paid down enough principal that the value is now great enough that you're below 80% LTV, there's no requirement for that MI to continue. With FHA, it does continue for the life of the loan. Important little differentiation there. Let's go on. And just talk a little bit about, some other key features here. Non-occupant co-signers are permitted. They're not permitted with the conventional conforming markets typically. There is allowance for the exclusion of deferred non-housing debts such as student loans, which can be a big deal. And really, FHA, even to this day, is more of a story loan. Those extenuating circumstances we talked about, those compensating factors come into play here, and it makes a big difference. So, Matt, your experience with FHA, is it a more flexible tool, generally speaking?
Well, I think your final point, Craig, about being a story loan is important. If you have a scenario that makes sense, and any reasonable person looking at it would make sense, but doesn't fit the conforming lending guidelines, which tend to be more black or white, an FHA is going to be a good choice. The only thing I was going to add, in the points you made, Craig, with regards to FICO credit scores, it's important to always keep in mind that we're talking about the middle FICO score, not the lowest or the highest, but the middle. So sometimes a borrower would come in and say, "Oh, I've got a 600 FICO score," and you ask them, "How do you know?" "Well, I checked it on, myfreecreditreport.com or something." And you really need to get a tri-merge mortgage credit report and see what that middle FICO score is, and often that can get your borrower approved.
That's a good point. Good point. Let's go on to the comparison then of the conventional and the FHA, get a little clarity on where one works. Oh, I jumped ahead. No, that's okay. Please go to the next slide. I forgot we were going to cover 203K here. A few words around 203K. There's, I read recently that some impressive results. The 203K had doubled the volume has doubled from 2009 to 2010, and again from 2010 to 2011, which sounds very impressive. It's still a relatively modest number. I think it's somewhere around, at the end of 2010, there were 22,000 2 or 3K mortgages in America, and our need, of course, is well beyond a few thousand. But this is an important product, and it is of growing use in NSP markets. And I want to differentiate between the standard 2 or 3K Classic and the new Streamline program. 2 or 3K is a 15 to 30 or 30-year purchase rehab mortgage. So it's a mortgage where you would buy the home, and you would also incorporate the renovation costs into one single mortgage payment. You can finance significant renovation. It could be $30, $40, $50, $60, $70,000. There's a minimum of $5,000. You can and this is important. You can finance up to 6 months of your principal, interest, tax, insurance. So let's say you're living somewhere else while your home that you just bought is being renovated. You can finance 6 months of that mortgage payment on your new home into the long-term 30-year mortgage, so that you're not caught paying a mortgage on two different properties while the renovation is occurring. A nice feature. The total loan-to-value, I should use CLTV, combined loan-to-value, is the lesser of the purchase and rehab price cost, or 110% of the appraised after rehab value. And I have to warn you, the cost associated with a 2-3K can be higher. It can be as much as 3% higher than a conventional mortgage without rehab. Let's look at the streamlined. With the streamlined purchase and rehab, it's a lot simpler. And I would encourage you, if you're going to go this route, if you're going to do a direct-to-home buyer execution, rather than use a turnkey developer approach, which is most commonly used, if you're doing a direct-to-home buyer, use the streamlined approach. Don't go to the more cumbersome and older program. This is simpler, easier, cheaper. 15 to 30 years again. The rehab must be between $5,000 and $35,000, so it's more modest. You cannot finance that 6 months of PITI, but you also don't have to hire the architect and the consultants and have a HUD blessing and approval. And you must start the construction after approval of the loan within 30 days and complete it within 6 months. But it is a more streamlined vehicle. We'll answer your questions about this in a minute. Let's go to the comparison here. Oh, keep jumping ahead. Portfolio products. A number of you asked questions about portfolio products, and I don't want to start doing infomercials for lenders, but there are a number of products that we saw through the roundtables, and also some that we have been made aware of that are close to being announced, that is creating excitement for me at least. In the one product we heard that was broadly being used in a number of roundtables was one that U.S. Bank has, called the American Dream product. It's a 97 LTV. There's no mortgage insurance on it. There's a requirement for a $1,000 borrower contribution. The rest of that 3% can come from other sources, and you can even build in some minor repairs into the project. So we thought that one was a worthy contribution. Union Bank in California, I know, has a portfolio product that might be applicable here. There's at least one of the top 3 or 4 lenders that is about to announce very shortly, I'd say within the next 30 to 45 days, a portfolio product for NSP that is also very flexible. It has no MI associated with it. I think it's also a 97 LTV, and I really can't say too much more about it because it hasn't been officially announced, but another product that I think will be an important complement to the products that we talked about here today. All of those, back 1 second, just that last bullet, all of the common themes in these portfolio products are low borrower down payment, typically no private mortgage insurance, manually underwritten, it's not automated, and typically focus on community stabilization and have a counseling requirement built in. Okay. So when does conventional make sense and when does FHA make sense? I'm going to ask Matt to comment on this in a minute as well, but borrowers who have generally a better credit history with a minimum FICO of, it's always dangerous to cite a number here, but generally in the 660 or above, conventional is a good bet. Make sure if you're thinking of using My Community or Home Possible that there's no bankruptcy, foreclosure, or other serious credit issue like that within the last 4 years. It's important to look at a total debt to income that doesn't generally exceed 45%, although sometimes you can get approval beyond that with automated underwriting. Generally think about a 5% down payment from that borrower or other soft sources. And you're going to have to document all of the sources of that borrower's income. That's a key for conventional lending. And what does this last bullet mean? Well, what it really means is, we go back to the point we made earlier, that if the LTV, if you're providing a deeper soft second, you're providing 15% of the cost of the purchase, and so the initial loan to value on the property is only 85%, you might want to encourage that borrower to look conventionally, because when they get below 80% loan to value, they won't have to pay that insurance cost anymore. With the FHA, lower credit scores are a key factor. Bankruptcies, foreclosures, their threshold is 2 years, not 4 years. So another reason you'd use FHA. They might have a lower down payment. It's only 3.5%. Or unique credit, income, or asset characteristics that create that story loan that we were talking about earlier. And certainly if the combined loan to value exceeds 100% with your soft second and the first, FHA tends to be a little bit more flexible there. Matt, any thoughts here on how do you go about deciding whether it's conventional or FHA?
Well, we start off first, if the LTV is at 80 or below, then we assume that the loan is going to be conventional unless the borrower doesn't otherwise qualify. For example, if they've had a bankruptcy, less than 4 years ago, but, at least 2 years old. In that case, you would automatically have to go to FHA. If there's some other factor, such as you're trying to defer student loan and not include that in the debt-to-income calculations, then that might be another factor. But in almost all instances where the LTV is at 80 or below, we generally find that a Fannie Mae My Community or Home Possible from Freddie Mac would be the most economical choice for the borrower. If you're above, as you said, Craig, 80% loan to value, then on your first mortgage and you're trying to use subordinate financing, it's probably going to need to be an FHA loan because you're still going to need mortgage insurance on the first, and I'm not sure the private MI companies are set up yet, at least with any sort of scale, to insure a first mortgage where there's subordinate financing. I've heard at least one of the MI companies can do that, but I've not actually personally seen it happen.
And Matt, do you ever run a loan through DU or LP to see how it plays out, and then use that as sort of your guidance?
Yes, almost always. I mean, those are excellent tools, and if you don't get an approved eligible or an accept through those systems, then and you've made sure you've submitted it right, that after that you'd really start thinking about putting together as an FHA deal, assuming you think it makes sense and it meets the FHA guidelines.
Great. So I think we're at a good stopping point here. If you go to the next slide here, and we just check here. Or not?
We do have several questions.
Yep. Why don't we take those right now?
First one is, are you finding a lot of the 203K loans working for the NSP2? Who is using them? Are they finding them to be efficient?
I might ask HUD if they're hearing much on this, John or David. But from my perspective, what I would say is that I've heard more use of 203K Streamline in the last 6 months than I heard in the previous 2.5 years. It's still more expensive, and there's still this concern that many of the NSP grantees have that it's too daunting to incent a home buyer to buy in one of our target markets and also take on the task of renovating the property as well. So for that reason, I think it sort of minimizes the level of use, but Streamline seems to be much more workable than the Classic. John or David, are you hearing that?
Yeah, I think that's accurate. I actually hadn't heard, this is John, too much about the Streamline, but I know it was problematic the first couple of years, and part of it was, the grantees wanted to do the payouts, and the lenders wanted to do the payouts, and so there was a little bit of confusion on that side. I do think it makes sense if you got a limited number of repairs or maybe some cosmetic stuff. David's got some observations here too.
Yeah, I didn't catch your comment, but did you mention Phoenix?
No.
Okay, yeah. So Phoenix, one of our NSP2 consortium members, has been working with Bank of America to assist home buyers with the 203K program. And they've done a number of homes. I want to say it's a couple hundred at least. So you might reach out to them and get some pointers on how their program's working.
Yeah, I think one of the benefits too, David, to your point, is that if you have on staff, if you're a city agency or a nonprofit that has your own rehabilitation specialists and you know how to do cost estimating and work specifications, you can be that advisor to the borrower on a streamlined 203K, and maybe allay some of the concerns that home buyer would otherwise have because they don't know enough about the process.
Right.
We also have, I believe, a statement. Nonprofits that are not instrumentalities of government cannot assist with the FHA down payment requirement. The buyer has to come out of pocket with money or it can be gifted.
Well, I think that's sort of the issue we were talking about briefly before, that I think the term, and I don't have it in front of me, is a government entity or a nonprofit that is acting on behalf of. Some of the slowdown that we made quick reference to a minute ago are with other nonprofits that are looking for that blessing to be a provider of the soft seconds. John and David, I don't know if do you have comments on that, or perhaps Matt from your first-hand experience out there.
Yeah, well, we talked about this a bit last week. There is a policy alert from May of 2010 that talks about the FHA mortgage insurance for NSP grantees, and there are some restrictions on the seller providing down payment assistance, and then there is also a requirement for any nonprofit soft second mortgage lender to be approved by FHA, and that sometimes takes longer than people want it to, and in some cases they have not been approved because they don't have sufficient lending history, for example. So that can complicate the question a little bit. I don't know if there's a way to modify that. As I mentioned last week, there is a requirement right in the Housing and Economic Recovery Act that prohibits this seller from providing the down payment assistance. The other requirement for FHA approval of secondary lenders is a long-standing requirement, and frankly, I don't see them moving a lot on that one. So I guess it's encouraging to me to see that Freddie and Fannie are developing these programs that kind of mirror FHA, because hopefully they'll be a little more flexible in how they can administer them.
Yeah, I think there's an inherent legacy mistrust in nonprofits that goes in FHA that goes back to some abuses that were, 15, 20 years ago now, and largely around 203K. But there probably is. I know the current administration are looking at some ways to streamline that process. So I agree with John. I think the future will look a little bit easier than the recent past.
For the next question, I'd like to give a quick reminder. To ask a verbal question, please select the hand icon. You'll be placed in a queue, and I will identify you once your line has been unmuted. You may ask your question, and then please deselect your hand icon. The next question we have is there a maximum loan amount on the 203K?
For Streamline, it's $35,000. For the overall program, I don't remember seeing one. Does anyone else remember? Rob? Matt?
I think it would be whatever the FHA regional limits currently are, which I think across the country is in a 417 with exceptions for high-cost areas.
Yeah, but nothing on the rehab per se. Although value sometimes becomes a determinant there, right? Because it's got to be, the maximum is going to be the purchase rehab cost or 110% of the after rehab value.
Right, it's based on the after rehab value.
Yeah.
Next question, does the middle FICO score always relate to the experience score?
No. The middle FICO score can be, any of the three bureaus can be the one providing the middle FICO score. It's not tied to any one of the bureaus.
Great. Next, is anyone using VA financing with NSP?
Yeah, that's a good question. Go ahead, Matt.
In theory, you could. As a practical matter, and this is hard when you're talking to a vet because you want to give them as much assistance as you can, and they're often very happy that they have the VA eligibility certificate. But the primary benefit of VA is that, there's little or no down payment required, and so what we're providing is down payment assistance, and so we're providing what, in a sense, they don't need. And if really what they're looking for is affordability, then some of the other products we've discussed will actually, at the end of the day, might be more affordable in a VA loan. So I haven't found it to be a good fit or wherever it makes sense.
Okay, next question is, what is the minimum time wait for a short sale to get a conventional loan and FHA loan?
Now, see if I understand the question correctly. Is it the minimum time to wait for the short sale to be executed, or are we talking about minimum time for that defaulted family to qualify for a new mortgage if they didn't get foreclosed upon but actually sold through a short sale? If it's the latter, I think it still sticks to the same rule. So whether it was a foreclosure or bankruptcy or a short sale, I think the GSEs are going to look at the 4-year standard, and Freddie and FHA probably the 2-year standard.
Yeah, I think if it's a short sale and the borrower is not in default prior to the short sale and there's no other derogatory credit, then most cases it's 2 years post short sale. And that would, in my understanding, that applies both to conventional and FHA.
Oh, that's good news.
Of course, there could be individual lender overlays for more strict requirements.
Yeah.
Next question, what agency or bank did the responder mention? Did not get the name.
For which instance was that? Was that for the portfolio products?
Unfortunately, the question doesn't clarify. This is from Sandra, if you want to clarify your question. Next question, will NSP allow a non-occupant cosigner since the home must be occupied by the buyer?
That's a good question. Matt, why don't you explain the difference there with FHA?
So in FHA, you can have a non-occupant co-buyer, someone who is not going to be occupying their home as a principal residence. So a typical scenario there would be, a young couple getting married and one of the parents co-signs for them a loan to add their income and credit to the loan application. And FHA will allow a non-occupant co-signer to provide up to all of the borrower's qualifying income and credit. The difficulty is on an NSP transaction, you're always looking at household income, and so the NSP guidelines or other, community lending initiatives going to be looking at the total household income, and typically you're not going to allow for a non-occupant co-signer or co-buyer.
All right, maybe we should move on here and complete our last segment here.
Craig, can we jump in on that one a little bit?
Yeah, please.
We think that just talking here, but we think that the cosigner on the loan is not somebody that gets calculated into the income limits. So that, we're not. We need to verify this, but we think that the family could qualify based on the occupants of the home, and if they have an uncle or a parent that's co-signing the loan with them, that would not be. We don't think that's counted in the calculation, but
unless for some reason they were being counted as a deductible, a dependent.
Yeah.
And then that would be considered the household.
Okay, so it sounds like the operative factor there is if they're not considered a member of the purchasing household and serving as a co-signer, it may not impact the income qualifications.
Yeah, that's what we think.
Okay. All right, Rob?
All right, just you've got up on the screen sort of the key takeaways from this conversation. The first bullet point, we're not really saying to you you should become an individual advocate for every borrower and go argue with lenders and make them prove that it's the best product. But I think in one of the recommendations that was made earlier, as you start working with lenders, as they are comfortable with your soft second products, and as you're comfortable with their processes, and you start to, let's say, put them up on your website, these are lenders that we've done business with. You're not endorsing anyone. You're just saying these are the ones that have done business with our NSP program. You can have conversations with them about what products are you choosing for people who are taking our soft second. I mean, which ones out there seem to be working. And that's not necessarily putting the lender on the spot as much as it's saying, look, we're curious what's working for you. We have some of our partners who are doing home buyer counseling. What sort of things should people be looking for before they come in? So in this regard, it's just the partnership that you want to get to with your lenders so that you understand the products they're making available to people that are using your assistance. And the second bullet point, to the extent that you can help them, one of the things that we heard that was, I think, a large frustration for the lenders that were in all the roundtables is that these were the community-based, the community lenders. These were people that were trying to do affordable mortgages in tougher communities where appraisals sometimes can be issues, where all sorts of things can rear their ugly head to stop a closing. They get paid for the loans they make, so they want to make loans. And when their credit committee or their particular underwriter or their risk management person assigned to them is shooting down loan after loan after loan, they asked NSP grantees for assistance. Please give us some ammunition that we can go to our credit committee or go to our underwriter or go to our risk management person and say, here's what's going on in this particular community. Here's the types of home buyers that are coming through this NSP program. Here's the assistance that's being given to them. Here's the track record of what has gone on so far in terms of loans made, a number of delinquencies, all that sort of stuff. They're looking for help from you in terms of how to move this forward. And so that I think takes us right into the next, which is the next slide, which is collaborating with lenders. Now, the key to this is the word lender does not have one meaning. It represents one institution, but financial institutions are as siloed as any other large bureaucracy. So you may walk into a branch and ask to speak to the branch manager and think you're talking to George Bailey from It's a Wonderful Life, who will make decisions on loans that your borrowers come forward on. The answer to that is no, that in fact in branches they may or may not have someone full-time who makes mortgage loans. More than likely, even if they do, those are not people that understand government assistance programs. Those are what we refer to as the vanilla mortgage lenders. You come in, you put 10 to 20% down, your credit score is 750, you're buying a house that has, either the value you've negotiated with the seller is going to be where that appraisal comes out, all those sort of things. There's very few hiccups. When you start talking about mortgages that require down payment assistance or some of the other government programs and have some special tweaks to them, that's not usually at the branch level. There's no one in there. And sometimes they'll have people that rotate and they stop in once a week, but you have to hope that you're there on the time they're rotating in or come back when they are. Every large institution has a community lending group. They may be all over the country. They may be acting in the role of support to someone locally who will process your loan, or they may actually do it from wherever they are, and it's done sort of using technology. So when it says collaborating with lenders, you've got to first figure out which door to walk in. That doesn't mean you can't walk into a branch and say, I'm doing an NSP program, and I need to find out who the community lending person is. But you as a municipality, or you representing a municipality as a sub-grantee, should be able to make contact with, no matter how big the institution is, with someone, the public relations staff, the government relations staff, somebody with the word relations at the end of their business card, and be able to say, I need to spend some time with your community lending group because either you were having issues or we're going again now with NSP3 or we're using program income or whatever to restructure and redo our assistance program, and we're looking to be able to get somebody in our stable of mortgage lenders. So it's the biggest hurdle is figuring out who within that institution to talk to. Those folks, along with your local government relations and public relations people, have the vested interest in working with you. Their role is to represent that community. You may find that your biggest advocate in a bank is not a mortgage lender, but is somebody in the public relations side of that institution or someone in the government relations side. And when I say that, many of these institutions do business with your local governments, underwriting bond issuances, being city depositories. That's where the leverage is. That's where the sort of relationships that they want to keep with your city or your town or your state are going to come into play. So designing a program that provides tangible benefits to the lenders, the home buyers, and the community, well, that obviously is the win-win-win. But in the end, you have to structure a program that fits within the abilities of the lender. And I don't say that in terms of, athletic ability. I say that in terms of system ability. The systems now are larger and larger and larger. They're doing, if you remember back to the beginning of the foreclosure crisis, one particular servicer, who is also a very large financial institution, was fielding 95 to 100,000 calls a day. So when you have to deal with a multitude of things going on in what was sort of a nice mortgage company business 10 years ago, you are struggling to do anything other than one way and then trying to get everyone to fit into that one way. So find out what your lenders are doing and do the best you can. This repeats what I said in the earlier segment, to fit into the way they're capable of doing it. Otherwise, they may say they can help you, and you may expect to be helped, and 3 months later, or 6 months later, or 9 months later, you're still waiting for a loan to close. Again, we talk about articulating to the lenders the value proposition. That's more in terms of the ammunition piece, giving ammunition to the people you identify that want to make loans in your community so they can describe the credit risk accurately to their committee or their individual underwriter assigned to them. We can go to the next slide. All of these bullet points all are true and yet may or may not make a difference to the lender. You have to determine that in your conversations. They may say this really helps and this sort of information is going to help us build a better argument for why our particular credit risk in this particular neighborhood to these particular types of borrowers is within our tolerance. On the other hand, they may say, we just can't accept this sort of information. We have to do everything the same way everywhere across the country, and we can look at values, that's what we look at, but we can't look at the sort of extra bells and whistles you're building into your product. What you hope is that fewer of the lenders take that position, and the ones in your community, even if it's the large bank, will sort of listen to you, take that as part of building an arsenal for an argument, and go forward. So, again, I talked the last bullet point, lenders can strengthen community ties and gain recognition. Again, some care about that more than others. Some view that differently than others. It's a matter of learning what the tolerance of and the culture of the institution within your city is. Even one institution, one large national institution, may have different thoughts about different geographies for all sorts of reasons. I don't mean to make it sound as complicated as it is, but it's getting a sense of who those folks really are and what they need in order to serve your community and how much their motivation is to serve your community. These are questions that, quite honestly, you'll probably never get an honest answer to. If we go to the next slide, gauging lenders' commitment. They're always going to say you're a priority market. I've never had someone walk into a financial institution and say, is this a priority market to you, and have them say no and get out of my office. So they're always going to respond positively to that. Whether or not they're going to open more branches does give you an indication of their commitment, of their view of what they get out of that community. What's their market share? How do they view it? So you don't have to ask them that question as much as look at their prior behavior. If they're closing down branches and shutting ATMs in your community, they're viewing their market share as dwindling and their interest may fall down a bit. If they are stable or growing, that gives you a much better chance to say, we want to help you grow in our community and we want to provide you with borrowers. How you can support them in their Community Reinvestment Act goals, that is very tricky because you'll never totally understand how they do their CRA analysis. You can even read their performance evaluations and not come away with the best understanding. And plus, they're usually 3 years old by the time they're published. But you can get a sense if they have an interest in expanding their affordable mortgages for purposes of meeting the lending test under CRA. You can do that by reading past commentary in their performance evaluations. And you can also ask, there is no financial institution on the face of this, I was going to say earth, but I can't really say that, in this country that doesn't want more good quality low to moderate income mortgage loans, either low to moderate income borrowers or made in low to moderate income neighborhoods. They're always going to be in search of those to meet their Community Reinvestment Act. But the overarching view now is that safety and soundness trumps Community Reinvestment Act, especially in this current environment we're in. So you still have to say to them, we're bringing you quality borrowers. We can give you a pipeline of quality borrowers. Here is how we can, show you that's the case, and here's what we can do. So building that relationship with your local lenders is getting past sort of the most important thing. They always view that community people are in to ask for something, to demand something, to protest something, or to simply yell at them. So trying to get them to see that you're trying to produce a win-win. You want to give them more business, that the only way you're successful is if they get business by making loans, and the only way they're successful is making loans because they certainly can't just sit on the money you've deposited because they go out of business if they're not making loans. They can't live off the Fed window and your deposits and just sit on the money. So if we can go to the next slide. I've talked about a few of these conducting training sessions. We heard last week from Kim Stans from Columbus. He's actually brought a number of his lenders together to talk to them about the NSP program as it's being run in Columbus, to train them on what they go through in terms of assistance to borrowers and what their programs look like, and to hear from the lenders in terms of what their needs are. I really want to impress the third bullet point, create a list on your website of the active certified lenders. Again, you're not endorsing a particular lender. You're simply saying these are the ones who've completed a few transactions, who've done some loans successfully using our assistance under the NSP program, and that can educate your borrowers in terms of where to go to start to get that first lien assistance that you need them to get. And creating marketing materials, obviously that makes sense, but it's more important to get them into a face-to-face conversation. Dropping off frequently asked questions or cheat sheets or brochures is not going to get you where you need to be unless you're doing it as part of the end of a face-to-face conversation, whether that's in a group setting or individually. Then you can, those sort of leave-behinds make sense. Next slide, please. These are the takeaways based on, we've talked about all of this. Craig, I'm going to see if you have any additional information or thoughts. The last bullet point is where you can look for people's CRA performance evaluations. Again, they're worthwhile in the sense that they can, if you hone in just on the lending test, you can get some sense of things, but they are very dated, and some banks only want to be satisfactory. Some really want to be outstanding for different reasons, and so that's another thing you have to understand. You can ask your local institutions, is your goal to be outstanding or satisfactory? They may or may, again, whether they tell you what they want you to hear or they tell you the truth, you'll never know. But it's the best thing you can is to ask the question. Craig?
Rob, the one thing I'd say here on this last point of the CRA stuff is CRA is slowly coming back. The big banks, the regional banks that want to expand are looking at it seriously again. And OCC, many of you know this, but OCC a year and a half ago came out with a regulation linking neighborhood stabilization programs to CRA benefit. We still see a lot of lenders, particularly the lenders on the ground there in the communities that are not aware of this, and it is one of those factors that may incent them to take a more serious look at your programs. There's a fact sheet that OCC put out, I forget when, but the Office of Comptroller of the Currency put out a fact sheet that describes all the various ways that national banks and others that they govern can get CRA credit in neighborhood stabilization program activity. Lending is one of the primary ways, and they make it more flexible than it typically is. Typically, it's for low and moderate income lending. In this context, it's for low and moderate income lending or anyone in an NSP target market. I believe, but I know it's certainly up to the 120% AMI that NSP allows. So it may be something as another argument, another point to throw into the discussion. I noticed someone just asked me about what does OCC stand for. It's the Office of Comptroller of the Currency, the regulator for the national banks and the Federal Savings and Loan. So they cover all the big guys: Bank of America, Chase, Wells Fargo, Citi, U.S. Bank, all those regional lenders. It's sort of the regulator these days. So I think we've reached basically the end of our presentation. Are there any other questions or?
We do have a few questions.
Okay.
As a final reminder, you may ask a verbal question by selecting the hand icon. You will be placed in a queue. I will identify you once your line has been unmuted, and you may ask your question. Please deselect your hand icon once the question has been answered. The first two things we have are more of a statement. First one is, yes, we have used VA financing with our NSP. And the next is the 203K standard program for the agency and banks that are using this. Would like to contact them?
Contact who? I mean, I'd suggest if for more information, check the FHA website. So HUD.gov and go to the /FHA and search for 203K. You'll get some good fact sheets. Be careful. There's a bunch of websites out there that I've encountered that look an awful lot like the FHA website, but they're not. They're just mortgage companies trying to look like the federal government. But if you go to HUD.gov, you'll get there. There, among the top lenders, the national lenders, the only one that I know is very actively engaged in 203K is Wells Fargo. I think Bank of America may do a little bit of it, but many of the regional lenders also participate. But FHA could tell you that as well. And you might check with the FHA homeownership centers around the country to get some of that information as well. John and David, I don't know if you have any other thoughts on 203K.
No, I think you're closer to it, Craig.
Okay.
I also have a question from Shanta. Unfortunately, you don't have a phone icon next to your name, so I can't unmute you. Please push your question in the Q&A panel, and I'll read it aloud. The next question we have is, you all spoke briefly about appraisals. What has been the trend with grantee purchases, a property, and it's appraised at one amount? Then, about 6 months later, a potential homebuyer gets the property appraised, and there is significant decrease in value.
Rob, you want to?
Well, and I actually mean this, welcome to the horrible world of appraisals. The problem is two different appraisers can come out with very different appraisals. The second is in 6 months in this market, you can actually see decline. We're still not, we haven't hit bottom yet. Certain markets we may have, other markets we haven't. So one of the things to do, we talked about this last week, is if you're a grantee and you've purchased a property based on an appraisal, assuming it'll be at a particular value post-rehab, or if you're not doing much rehab, is to what you can, as the seller, provide that information to the appraiser retained by the lender. There's all the rules now about lenders not being able to talk to appraisers does not prevent you from talking to them. So you can say, this is what we did, this is how we did it before. So at least you can get an understanding of why all of a sudden they're coming in $10,000, $20,000, $30,000 less. The more you can educate the appraisers in your community around the issues that you're doing, the type of rehab you're doing. Remember that they may be just using comparables of distressed sales in your neighborhood, and those may just be people who bought REOs, slapped some paint, and sold it. You're probably doing more extensive rehab. So it's a question of educating the appraisers, all of them in your community, and not being intimidated by the rules now that prevent lenders from talking to appraisers directly. You can still do it. So in this case, I'm not surprised that a 6-month period passed and you may have seen a decline in the value of the property. I'm also not surprised that if 2 different appraisers looked at it, they came out with different values. One of the morals of the story is sell quick. I mean, if you get an appraisal and then you want to sell it at that price, the quicker you sell it, the more likely the purchasing appraisal will be closer to what you want it to be. We are just in a bit of a volatile market, but education here, I think, is the key.
Yeah, I couldn't agree more, Rob. And I think the whole definition of a comp, you're deriving value from comparable sales. Well, in your declining neighborhood stabilization market, that comp may be, as Rob suggested, a property that really isn't a comp. It's not comparable. The level of rehab was cosmetic and not substantial. We had a number of participants in the roundtable leave the roundtables, go back and organize meetings with their local appraisers. Some of them just picked 3 or 4 that they knew could be responsive and met with them, but others met with a broader set of appraisers to change their perspective on what's happening in that neighborhood, to inform them. The level of misinformation and frankly, ignorance around NSP among some of those groups, those appraisers, was palpable. So, again, a number of you have said this. Rob said it a couple of times. Don't be shy about making sure that people see what's in front of them. Appraisers may rely on their sort of tried and true but safe harbor ways of estimating value, and it's only going to hurt you.
Before we move to the next question, I do want to give a quick reminder. Please feel free to fill out the survey. You should be seeing that on your screen now. The next question we have is, where can I get the info again about the OCC, CRA, and NSP? What keywords would you suggest I use to find it? I have a lender breakfast tomorrow and would like to share it.
I have an answer for that, Craig. I looked it up on the NSP Resource Exchange and just went to the Find a Resource page and used the search word comptroller, and then came up with the regulations that say that NSP investments count as CRA. So if Shauna wants to go on there and just search for comptroller, it was like the second response that came back.
And John, what I'll send to you, and maybe you can forward as well, is there's a fact sheet corollary to that, which I was just reading, so I have it in my system. I'll send it to you right after this call.
Yeah, actually, there may be a way for you just to post it on this site. I don't know. I'd have to defer to the technical people, but some of these programs allow you to, just pop it right on there too. So yeah, that would be helpful. I don't think I've seen that.
I would just like to add, having unfortunately had to do CRA compliance for a large financial institution, one of the questions you may get from the banks is, what kind of credit do I get? And even when they read that, they're not going to be sure. You don't get a loan unit type of credit, which is how the lending test is enforced. It's all on tables. It's all based on how many loans you made and where did you make them. It's not an investment credit, which is another one of the tests, and it's not a community services credit, community development services. But what you can say is it's an addition. It's a helpful credit which can move you off of, if you're between ratings, to the next rating up. So it's kind of like extra credit, but I wouldn't use that phrase. I would just say it goes into the overall calculation and the lending test, and it gives you more assistance in terms of pushing you forward in how the OCC views your final rating under the lending test. But it's not quantifiable within the actual exam.
So I have the actual web connection. It's a little long. Would you suggest I read it or what?
Craig, why don't you include that in what you send me, and we will edit the slides and put them up on the Resource Exchange with that link and then the 2 links from Fannie and Freddie.
Great. All right, will do.
Thank you.
The only questions I see that we have left are from Sandra. Sandra, there may need to be some clarification. Please raise your hand if you want to verbally ask these questions. The first one is reminder about question on the 203K traditional. Not sure which question she's referring to.
Yeah, I think what we'll do there, Sandra, is I think you're looking for more information on the 203K standard program, the details, and what we can do is post some fact sheets on that as well, along the same lines that Hunter just mentioned.
She actually has her hand up, so I'm going to go ahead and unmute you, Sandra. Go ahead and clarify any questions that you have.
I think that works. This is Sandra.
Okay.
Okay, but your posting will work for us.
Okay, great.
Yeah, thank you.
Sandra, I'm sorry, you also had a question. What are agencies, banks using this a lot?
I think Craig answered that one in mentioning Wells and Bank of America, but also to check FHA.
Okay.
Right. And I think maybe the key is calling your FHA. They call them HOCs, home ownership centers. They're around the country, and you can easily find them by a search. Because they'll know not only who is very active. Sometimes very small lenders are specialized in 203K, and they do a lot of business that way. Has that been your experience, Matt, as well?
Yeah, it's a program. Well, it is a niche program. You've got to find the right bank and loan officer who's doing it. There's some loan officers that just, they've not built their business around it, but there's some that's all they do. So you really have to ask around.
And then the last question I see is, I think, a follow-up question. Possible to get today from anyone the OCC link? Will you guys be posting that?
Yeah. Shonda, I see your email here on the system. And this is Craig Nickerson. I will email you that link directly, but for everybody, I think what HUD said is they'll have it up rather quickly.
Craig, what we'll do is, and just for everyone out there, we'll have these slides edited on the Resource Exchange to include these links. And then in next week's presentation, I think we'll try to add these links too, so people can look for it there.
Okay.
And the last thing I have is posting fact sheet on 203.3.
Okay, we'll post the fact sheets on 203K, 203B, all the basics there.
Great. I no longer see any questions in the Q&A panel or any raised hands.
Okay. Rob, any final words?
Not a one.
Okay. Well, thank you then to HUD and to all the participants for this opportunity. And don't get discouraged out there. I think the more we engage the lenders and push for the right kind of responses and enlighten them on what we're doing on the ground, the better it's going to get. That pendulum is beginning to swing back towards the middle, and hopefully that means a lot more mortgage capital for your homeowners. Thank you all.